Let's jump right into this. You tell yourself, if the price hits this exact level, I'm going to exit the trade. It sounds incredibly disciplined, right? You've got a plan. But here's the thing, that right there is the illusion of the mental stop loss. On the surface, keeping a stop in your head instead of actually placing it in the market seems like a smart strategic choice. Maybe you're just trying to avoid getting wicked out by a crazy volatile market. But for the vast majority of traders, a mental stop loss is secretly an absolute account killer. It's a silent destroyer of capital that masquerades as discipline, but in reality, it's just an excuse to delay taking a loss.
So look closely at your own trading journal for a second. Are your planned, tiny, completely acceptable losses somehow magically turning into major account blowups? Because what usually happens is that when that predetermined price level actually hits, your discipline just evaporates and emotions take over. You hesitate, you hope, you move that imaginary line in your head the very second the market moves against you. And suddenly, what was supposed to be a small, manageable paper cut turns into a massive bleeding wound on your portfolio. If you struggle with this, trust me, you are not alone. But it is quietly destroying your edge.
Okay, let's dive into this. We've all heard that exact voice in our head, haven't we? It'll come back. The support is just below. Let me give it just one more minute. That is your emotional internal monologue, grabbing the steering wheel at literally the worst possible moment. The problem isn't the idea of a stop, it's the execution. Mental stops fail exactly when they matter the most. During fast moves, wild news events, or sudden liquidity gaps, your brain goes into absolute overdrive trying to rationalize holding onto a losing position. You're basically relying entirely on your own emotional control in a high-pressure, incredibly emotional environment, and that is a recipe for disaster.
To truly understand why this is so dangerous, let's contrast the two approaches. First up, the mental stop. It's highly emotional, it relies completely on your in-the-moment discipline, and it creates hesitation. Now, compare that to the hard stop. This is an actual automated order sitting on the exchange or with your broker. It is cold, calculated, and totally unemotional. With a hard stop, you already know exactly where the trade is wrong, and your risk is defined from the jump. If the price hits that level, boom, the trade closes automatically, protecting your account from your own hesitation and denial.
Now, what's really fascinating is the hard psychological data behind why we do this. These natural human behavioral biases fundamentally fight against your trading plan. Take loss aversion, for example. We naturally prefer avoiding losses way more than acquiring gains. It literally causes us to hold losing trades far too long. You know the drill, staring at the chart, suddenly convincing yourself that you're a long-term fundamental investor in a random setup you bought 10 minutes ago just for a quick scalp. Or think about revenge trading, where a frustrating loss pushes you to make aggressive, impulsive trades just to win the money back. When you use a mental stop, you're leaving the door wide open for every single one of these psychological biases to hijack your trading session.
And that brings us to a really harsh truth in trading psychology. Comfortable losing actually feels safer than uncomfortable winning. I know that sounds crazy, but a lot of traders stick to bad habits, like moving mental stops, because their brains have developed neural pathways that are literally addicted to familiar failure. You've repeated the behavior so many times that even though it constantly loses you money, it just feels natural. Breaking that cycle means you have to start doing things that feel alien and super uncomfortable to your brain.
So the crucial point is this massive realization right here, 2 to 3 times. Data from trading journals consistently proves that trades where a stop was moved or a mental stop was ignored result in losses 2 to 3 times larger than originally planned. By the time you finally override your own mental gymnastics and manually exit that terrible trade, the financial damage is already done. You didn't just lose, you amplified your loss by 2 or 3 multiples, purely because you trusted your willpower over a hard, mechanical rule.
Let's rapid-fire some of these common mental stop mistakes. Check your own habits against these. Moving your stop right after entry. Refusing to exit just because the loss feels too painful. Averaging down into a loser without any kind of plan. Holding and hoping for a miracle reversal. And finally, exiting way too late after you're in full emotional panic. Look, if you enter a trade risking $500 but then you move your mental stop just a tiny bit to give it more room, you just instantly doubled your risk to $1,000 without ever adjusting your position size. That one single behavior accounts for a massive percentage of blown accounts.
This perfectly brings us to the concept of R multiple, which basically measures your outcome based on your initial risk. Think about it. Taking a -1 R loss is actually a victory. That is good risk management. It means you followed your stop perfectly and your loss was exactly what you planned for. On the flip side, a -6R loss means you completely ignored your stop. You planned to risk $100, but you lost $600.
That is terrible risk management, and a single -6R blown stop will completely wipe out the profits from multiple successful winning trades. You just cannot be a consistently profitable trader if you're dropping -6R losses, all because you couldn't honor a mental stop.
So, what's the actual solution here? It's what we call the mechanical override. You have to accept that sheer willpower is simply not enough. You must remove the exit decision from the emotional moment entirely. If your mental wiring is fundamentally incompatible with taking a loss gracefully, and let's be honest, for most of us it is, you need external systems to override your brain. You have to use broker limits, bracket orders, and hard stops. You are quite literally using the trading platform's tools to protect your hard-earned capital from yourself.
Rebuilding your discipline requires a very specific, step-by-step mechanical system. Number 1, you set a hard stop before entry. You do it before the adrenaline kicks in and emotions cloud your judgment. Number 2, you have to track your behavioral mistakes with actual data. You can't just guess how you're doing based on vibes. And number 3, you need to review your tick-by-tick execution after the market closes. This process completely transitions you away from emotional guesswork and builds a solid foundation based entirely on evidence and structured rules. And this is exactly where a platform like TradeZella becomes an absolute game changer. It takes your stop-loss discipline, which normally just feels like this fleeting, awful feeling of, oh man, I really messed up today, and it turns it into a hard, measurable metric. To survive in these markets, you absolutely need proper data collection. TradeZella acts as that comprehensive tracking tool, letting you log everything seamlessly. That way, you can actually diagnose your weaknesses instead of just feeling guilty about them.
The real superpower here is identifying the leaks in your system through TradeZella's tagging feature. For instance, if you hit your daily loss limit and you stop trading, hey, the system is working. But if you trade right through it, you can tag that as daily loss limit exceeded, which highlights a massive discipline problem. You can tag giveback violations or trades where you moved stop loss. When you filter your reports by these specific tags, the platform calculates the exact down-to-the-penny dollar cost of your bad behavior. Seeing in black and white that moving your mental stop cost you $2,000 this month? Yeah, that's the wake-up call you need to actually change. And this brilliantly illustrates one of my absolute favorite features, Trade Replay. Because let's be honest, looking at a static chart at the end of the trading day makes every single exit look so obvious in hindsight. But Trade Replay reconstructs the live panic of a trade tick by tick using 1-second data. It fully restores all the chaos and uncertainty you felt during execution. You can watch the exact candle where you hesitated, where you dragged that mental stop lower, and where your decision-making completely fell apart under pressure. It exposes the painful truth of your execution errors like nothing else.
To wrap all of this together, keep this quote in the back of your mind. Success means becoming a different trader entirely. If you want to survive and actually scale your account long-term, just tweaking a failing approach isn't going to cut it. You have to unlearn those deeply ingrained emotional habits. You have to fully embrace mechanical, uncomfortable systems like hard stops. A profitable strategy might feel totally unnatural and rigid to you at first, but choosing hard evidence over your emotions is exactly what separates the professionals from the gamblers.
I'm going to leave you with a somewhat provocative thought. What trading behaviors feel the most natural to you right now? Because the harsh reality is, those are probably the exact behaviors you need to kill. Stop relying on mental stops. Stop catering to your emotions in the middle of a trade and start relying on hard data and unshakable rules. It is time to start measuring your discipline properly. You can try TradeZella and get 20% off using my exclusive link today. Take control of your execution, and I'll see you in the next breakdown.